Gold is not just moving, it's being engineered. What you're seeing right now is not randomness, it's institutional precision. And today, they'll show you exactly where smart money is positioning next. Welcome back. Today we're breaking down XAUUSD using pure smart money concepts, no indicators, no noise, just structure, liquidity, and intent. Starting with a 1-hour time frame, the market structure is clearly bearish. We're forming consistent lower highs and lower lows, signaling institutional distribution. Notice how each rally fails to break previous highs. That's not weakness, that's controlled selling pressure from institutions unloading positions. This break of structure confirms the bearish intent. Once this level was taken, the market shifted from neutral to aggressively bearish. These supply zones above price are institutional footprints, areas where large sell orders previously entered the market. Above these highs lies liquidity, retail traders placing stops. Institutions target these zones before reversing price. This drop isn't emotional selling, it's engineered. Liquidity was taken, then price collapsed as institutions executed their real positions. Here we see a change of character the moment buyers lost control and sellers stepped in aggressively. This low is weak, meaning it has taken enough liquidity yet. Expect price to revisit or sweep it. Right now, price is consolidating, not random, but a build-up phase where liquidity is forming on both sides. Even inside this range, structure remains bearish, small lower highs forming, indicating continued selling pressure. Below current price sits sell-side liquidity, a magnet for price if institutions decide to push lower. The bigger picture. Distribution. Institutions are selling at highs and driving price toward liquidity pools below. So we have supply above, liquidity below, and bearish structure. This gives us directional bias. Now let's move to the 15-minute time frame where execution and manipulation become crystal clear. On the 15-minute chart, price is forming a tight consolidation after a strong drop, classic continuation behavior. We see minor shifts, but nothing strong enough to reverse the trend, just liquidity engineering. This range is key: equal highs above, equal lows below. Perfect liquidity trap. These equal highs are bait. Retail traders see breakout potential, but institutions see liquidity. Below, equal lows form sell-side liquidity. Both sides are loaded and ready. The previous impulse was strong, meaning continuation is more likely than reversal. Expect a possible fake breakout above highs, a liquidity sweep before the real move. This is where traders get trapped and where we position ourselves with precision. Sell setup: we wait for price to sweep liquidity above 4,535 and enter rejection. Entry at 45,354,550. Stop loss above 4,565. Targets: TP1 at 4,505, TP2 at 4,475. This trade works because institutions take buy-side liquidity, then reverse aggressively. This setup gives a clean 1:2+ risk to reward, exactly what professionals look for. VUY setup only valid if price sweeps below 4,500 and shows strong rejection. Entry at 45,004,485. Stop loss at 4,465. Targets: TP1 at 4,530, TP2 at 4,580. This works only if sellers get trapped, liquidity taken, then price reverses upward. Pro tip: never enter before liquidity is taken. Wait for confirmation, not prediction. Patience is your edge. Bearish bias, liquidity above and below, and too high probability setups. Now you're thinking like smart money. If you want more institutional level breakdowns like this, subscribe now and I'll see you in the next analysis. Now.